So, gratitude to our distinguished panel speakers today, Mr. Saras Agarwal, Managing Partner of Earth Fund, Mr. Sanjay Mandava, founder of the Landeed, Mr. Jitendra Jagadev, founder of Nestaway and Helloworld, and Mr. Keshav Jain, CBO of Brigade REAP. So I want to start asking first about very important aspect when a founder goes for raising fund. It's called pitch deck. So what are the elements that should be added and what should be omitted? Because these days VC are suggesting that the founders should disclose their vulnerability for an overall comprehensive view. But how does a Proptech founder would navigate this without negatively affecting the judgment of investor? So let's begin with you, Keshav.
No, I think it's a fair point, right? I think, and we are actually, as we're graduating the cohort, right? All five of our startups have just gone through the pitch deck process, right? And the first thing that we tell them is pitch deck will not get you funding. The idea of building a pitch deck is you treat it as something that will excite and get the meeting, right? I think a lot of founders get caught up. Should I get everything, all my details, especially at the early stage? Now, I'm talking about from my vantage point, which is the early stage, and not where I'm talking about the metrics, of a much later stage company. But I think the first idea is get your story out. Why are you spending the time? Why are you committing yourself to next 10 years to building this company? I think that is the first and foremost. Right? And I'll come to the point of being vulnerable, right? But I think great pitches really tell the story of why this founder has chosen this problem or what is that unique insight. I think the unique insights that you bring out, either A, in the understanding of the problem or that the solution, the way you're building it, right? I think that makes any VC person stand out, right? I mean, that is the first thing. And our advice to all our founders is keep it simple, right? Spend more time on the problem rather than the solution. And I think, rest of the panelists can allude to that. If you can show that you understand the problem well, because the solutions will change, right? As the company and as both the founders on this panel would probably, talk more about it, how the company undergoes changes. The solutions should be more directional, right? But understanding of the problem is key. And just without taking too much time, coming to the main point that, how do you show vulnerability, right? And we are dealing with very, very early stage startups, right? I think the way you acknowledge, and there's a very great article by Balaji Srinivasan, right? I'd urge every founder to read it. It's called The Idea Maze, right? Where he talks about, going through that entire journey, right? If you can communicate that you've evaluated, like where the people in the past have failed, right? What the market landscape is like, where do you see challenges coming up? It just shows your grasp of the industry and the problem. And one last point that I'd make, the way to showcase, not vulnerability, but self-awareness, that I'm aware that as I take on this journey, today my team or my solution is only up to a point. So if we can bring it out, because that's the reason you're taking the funding any which ways, right? So I would not call it vulnerability, but awareness. If you could display that awareness, right, I think that is very refreshing.
My take is very simple. Pitch deck is a sales deck.
Yeah.
You need to approach it as a sales deck. Now, having looked at multiple pitches over last 10, 12 years since I've been investing, I think good pitch decks, what I found is rather than getting into gory details on the first meeting or the first pitch deck that you share, there are few basic things that you want to capture. Any person looking at that pitch deck, their attention, what they want to look at in a good pitch. You're operating in a large market. I think that's an idea you need to communicate very clearly. So to be honest, I have, I've seen pitch decks where people maybe try and showcase a market which could be barely 200 crores, 300 crore. Those are certain areas which honestly doesn't excite investors. People have different thresholds. Few people say, hey, I won't touch a company or a space if it's not, targeting $1 billion sort of market, because anyways, you will be, capturing fraction of that market. So I think market that you operate in, it's important to capture that, and why the problems in that market and the problem that you are solving, that's important to capture. Why you folks are the best one to lead it in terms of, that's essentially the team. Where exactly are you in that journey? That's very important to capture, which essentially is your traction or whatever at a high level that you want to communicate. And what's your ultimate vision? See, startup journey is it's a long journey, right? There would be sort of a lot of changes, pivots along the way. But eventually, what's your end goal? Where do you see this business? Maybe today you start with, let's say, a for example, I'm sure Jiten can give a view, but when he would have started to where the business now, it's very, I'm sure it has evolved and, changed much. So I think that communication of that vision is important. Regarding vulnerabilities, to be honest, I would avoid putting it personal, vulnerabilities and, the kind of maybe certain problem statement or something that you could include there in terms of and even then my suggestion would be take it in conversation rather than putting it in writing, because honestly that question would come up in the conversations. Better to tackle that when you are in conversation rather than putting it in writing, because you never know who's reading it, what people sort of make out of it. So I would always suggest that keep that for conversations. Pitch deck, keep it as your CB or sales deck, so that you get people excited, get to meetings and start the conversation.
So, Jitendra and Sanjay, you guys have in past raised funds, right? And I'm sure you can also tell the founders who are present here, when it comes to pitch deck, what needs to be omitted and how to touch upon your vulnerabilities or the pain points that you're facing without influencing negatively in the investor judgment.
See, the most important thing will always be the story, like, because I assume we are all like talking about the first round, the seed round, or perhaps the Series A. So the story has to be very impactful. Like, people should say that, okay, this is a big story. That if so, most of the investors work on a FOMO mode, right? So typically, if I don't invest, someone else might invest. Okay, so we have to capture that this is a story. If you're not investing, perhaps you're missing out. So that missing out has to be told as big as way as possible, and that has the largest impact, because later on, like, we're talking about all the important points, what is captured, like team and what's the traction. These are all the selection points which happens after the person is really excited about it. So to build that excitement is the first and foremost thing, and that will happen at this stage only with the story, and that has to be like the most important thing that has to be there. Unit economics is today is very important. Like, if you're talking about a B2C startup versus B2B there, but we are talking about, see, even the investment ecosystem has evolved largely as we speak, right? It was very different about 10 years back, very different about pre-COVID. Now it is very different. So people were talking about 2014, 2012, people used to talk about GMVs, right? Today, if you would take a pitch deck and mention GMV, perhaps it's a rejection criteria, right? So people are now looking at how great a PAT could look like. So how that has evolved is how VCs are evolved in their takes. So very important is, like, the story has to be there. It has to be good. Traction, how we are solving, like why we are the best guys to solve it. That has to be mentioned. And typically, what are the weaknesses areas typical not to capture, because everyone is looking to be on the optimist side. No one is looking at the weakness part. Everyone is telling how this can be successful. So that those parts can be completely ignored. But very crucial is also don't need to emphasize on 5 years plan, 10 years plan, 6 years plan, not required. Because like people will put, I've seen pitch decks where people actually say that everyone will be an unicorn in 5 years. And which is like those unicorns which happened in within 5 years have not even like been unicorns, right? So stick to the basic, make the story as impactful, and then go with the team. So those two things are the most crucial things, I would say.
Sanjay, coming to you, I'm sure during raising funds of Landeed, because Landeed was one of the model which no one had experimented in Indian market. We have a lot of primary players who are B2B or who are also the copy of a global, companies that are already given results. So when it came to your particular company, how did you go about your pitch deck? How did you go about the pain points, and what would you suggest founders to add in the pitch deck and also omit?
I would suggest founders not to send a pitch deck before a meeting. So it should be discussed during the meeting at most, but I would never send a pitch deck to an investor in the hope of getting a meeting. And most of the investors that we closed, we didn't even have to send a pitch deck. Meaning it happened in the conversation, it happened when we were during the pitch. And even if we did, it was more like a checklist of material that they wanted, and the decision for investing has probably. Now, in terms of like pitch deck construction, I always tell my team, like, even when we design parts in the company, what is a problem, what is a solution, and why are you the one solving? So if you are going after that kind of construction, Airbnb early pitch deck is one of the best examples on how to build pitch decks. So, problem, solution, market size, the founding team, rest, you can add 3-4 slides for other stuff, but that's about it. It's a reason for people to say no at times than it is for people to say yes. Nobody has ever said yes to investing in Landeed because they thought my pitch deck was beautiful. So that's one. In terms of vulnerabilities, what I would put on there, as a founder CEO, I don't think I'm vulnerable. I have challenges that I need to solve, but if I can't solve it, then who the hell is going to solve it? So why would I give people more chances to anchor around what are my weaknesses and who is anyone to judge what my weaknesses are? They're not in my shoes. They're not running the company. They're not working, 14 hours a day, 7 days a week, on your birthdays, on your wedding, everywhere. So I wouldn't really do that. And I don't think it's necessary. And so like VCs are putting out their anti-portfolios like Bessemer Ventures does. I haven't seen a single Indian VC put out an anti-portfolio on their website. The ones that they missed, ones where they made a mistake. And coming back to the point about like vulnerabilities and what to do, in terms of, I think great founders have a chance to reject tons of funds, and great funds do a lot of rejections anyway. The chance of being like, for instance, getting into YC is probably sub 2%, which is less than Harvard and Stanford. On top of that, you want to put a pitch strike that shows your weaknesses. I think I'm good to go. If I had weaknesses, I don't think I'd have the confidence to run a business. And I'm very confident in what I'm doing, and I have conviction in what I'm doing. So if you believe in it, that's great. Otherwise, good luck to your investments.
So the initial stage of pitch deck should be about storytelling, right? Tell your story, tell the problems, what you're planning to solve, and do not send the pitch deck before having a meeting. Have I covered all the major points about pitch deck?
So on that, I have a different point of view coming in from investor side. Around pitch deck, and see, honestly, while I think we wear different hats, I'm also raising funds, right, from my LPs.
Right.
And it all depends on, it's subjective in a way whether you are able to get that meeting without pitch deck. To be honest, even if I have set up that meeting, I would request that, I would want, send me something, even if it's small, because see, we also try and do some homework at our end before getting into conversation. That allows us to maybe move faster and make a decision faster, because, one might assume, see, honestly, as a fund, the problem that we have is we also work in fairly small and overworked teams, right? We look at different spaces. One misnomer is that we would have idea around every space. That's not true. We also learn from founders. And if we don't do that homework while coming into the conversation, somewhere, I think that meeting might not lead to a better result. That's a different point of view. But I hear Sanjay. He has gone to his own journeys. But as an investor, I prefer that even if small, maybe 3-page, 4-page, if you're not comfortable sharing everything, that allows me to do my homework before I come into a meeting. So I would prefer a deck, maybe 3-4 slides or whatever. So that's my take on that.
So coming to the point where you said you can send deck before the meeting also, it's a crucial thing. A very interesting clip has been circulating in Twitter of the interview by Vinod Khosla.
Just because you got an MBA and joined a venture firm doesn't mean you're qualified to advise an entrepreneur.
Where he has recently said that investors, 90% of them do not add value. And when it comes to 70% of them, they actually contribute negativity. He emphasized mostly on the individuals, young advisors joining venture firms, where they are the ones who are filtering these portfolios of founders, where they are lacking the experience of themselves, having a substantial entrepreneurial background, where they are asked to guide the founders, where they are asked to scrutinize the founder business model. So coming to this particular thing, it raised a lot of debates in Twitter. A lot of founders agreed to it, that huge venture firms have these young advisors who are an individual having just an MBA degree, and they are telling the founders how to run business. So the question comes, when it comes to selecting investors, what should be the criteria? What should be the checklist a PropTech founder should have in mind before selecting investors? And of course, avoiding such young advisors who have joined venture firms who are scrutinizing these PropTech founders. So before I go to VCs, I'm sure you guys want to jump into this. Jitendra, please tell me your viewpoint on this.
Touching on the last part, I think most of the founders will not have that many choices in the early round that I could select one VC over the other, right? So typically, if they get two VC, they'll try to join both of them and make the larger round. So, but more or less on Mr. Vinod Kostla's statement, I definitely agree to that. That 70% is a number which actually could be true. In my experience, like at least in my experience, like we have worked with a lot of large VCs. We have worked with smaller Indian VCs, and one of the drastic thing that I've observed is like typically all VCs are actually biased with their own set of portfolio, right? So have made success. It could be in a B2C market, and they might be advising a B2B market. Okay, but they will take this know-how and try to put in there, which may not be relevant. So that happens very, very often. And typically also very important is like the cycle of investment is very different, right? So typically if you're a US VC, your cycles are much shorter than typically when you invest in India or in China. China is also much better than in India. So when that mindset comes in, they will actually, they might tell you something that might be short term, very short term, and which might be in that time, which is very relevant. Whereas an entrepreneur has to think on a very long-term approach, because they have to think that, okay, I have to run this organization and I might be able to put, go for more number of VCs who might be with me for next 10 years. So ideally, we should not, as an entrepreneur, we should not actually be biased. We have to follow what our heart says, what the team says, that is more relevant. But we have to take all the feedback which may be useful to us, because that might have worked. Very simply, like for example, what could work in India may not work in China. But a VC who has invested both in China and India will say that where that has worked, why it is not working here. So then in that context, if we blindly take that, definitely may not work. So very important is like we as entrepreneurs, you have to believe our trust. We have to believe in ourselves and believe in your team. Team is very important, because those are people who are working daily on that idea. So, and then just go on.
Sanjay, what's your take on this?
Very true. I definitely look whether the investor that I'm looking at is a ex-founder or ex-operator. It matters a whole lot. You can tell in the quality of questions. You can tell in the way that they talk to you about tactics. So we take the example of, let's say, a management consultant typically going into a VC fund, and you're wondering what exactly can the person offer you? Where's the skin in the game when that person has gone through the process? I'm sure they have a breadth of knowledge in terms of the industries that they work with, but not many startups are hiring McKinsey or BCG or Bain, right, at early stage. That means these guys are naturally working with larger companies. Now, I've seen a lot of startup founders say, like, look, this is what Google is doing. I'm going to do it now. You're replicating what Google is today into an early stage startup, probably not a great idea. If you take early stage Google and transfer it into yours, probably a good idea. Google work every Saturday, Sunday, but I still hear about founders talking about work-life balance. I don't think India has the luxury of work-life balance because we're a developing country. We have to work hard and we have to work harder. So in terms of VCs kind of taking that management consulting route to investing, I think skin in the game is a very, very important aspect that I look for in investors, because VCs can make 100 bets. I only have one bet. It's my company. And I have to work on it for half a decade, potentially my entire lifetime. And until you're in my shoes about what it takes to put 95% of everything that you are into a single shot, which has a high failure rate, I think the mentality is very different. And just like I wouldn't adopt Google tactics now in Landeed, I probably wouldn't take the tactics of a management consultant that worked with late stage companies or public companies into giving me advice at early stage. And there's a lot of operational nuances, like how do I do marketing? How do I keep the employees together and have a single goal? I don't know how a guy that goes straight from undergrad to an MBA to a management consultant brings that expertise into a company that's maybe 10, 20 people, and things can add value. What are they going to do? Tell me to spend more money recklessly to grow, and then when it's convenient, shut it off, show me profitability, right? We build for the decade. I don't build for investment cycles. So that's a very different way of looking at things, and that's very different optics. So definitely operator founders are a step above, then angels with certain expertise, then probably below that, I will hail at early stage, give a lot of respect to solo GPs. And then at the very bottom, in terms of speed and optimal, whatever things that they can do, then maybe I'd start looking at, traditional venture funds at early stage.
That's quite an interesting point. Keshav, Sanjay pointed that, we build for decade, not for investment cycle. So, of course, having the right investor and having the skin in the game is important. So, what's your take on that?
So I think both the founders obviously have, pointed out very pertinent points, right? And this is also the dichotomy of venture, if you will, right? And if you understand the product that is being sold, right, to LPs is very different than the product that's being sold to founders, right? And smart founders understand that I'm working you mentioned earlier that I'm working on a 7-year, 8-year, 10-year cycle, right? I have promised returns. So either you cycle out your investors, right? No one's going to be with your journey from one till the end. And, since you mentioned YouTube and Twitter, right? Videos going viral, right? Twitter went viral with one of the best investors, Bill Gurley from Benchmark, being shat upon by Uber for saying he created, if that person, right, who's like the epitome of investing can be considered to be destroying value, then, forget zero, early stage investors or, associates, right? It's always going to be, difference in opinion. Now, here's how I look at it. I'll try and address some of this management consultant part, right? Completely agree. At early stage, the smaller the fund, the more hands-on, right? And that's what the approach that we take at REAP. And I'm not trying to plug in REAP here, but, we're going through the accelerator part, right? Most of the team has sort of tried to build some sort of venture, right? But it's important to understand the role of this associate level that you're talking about who's trying to reduce this value, right? In venture, there are two parts, right? One is getting selected into venture and then the value add. The reason that every fund starts saying, oh, I'll value add is because otherwise the color of my money versus another investor's money is green, right? A great founder has the ability, right, to choose. Only when the founders don't have the ability to choose, they're at the mercy of what is available to them, right? So I think that's two kinds of founders. Now, I would say to get through the gate, like any sales, right? You have to say the things, right? Or demonstrate the ability so that you go through the gate. After that, you have to put on your founder's hat and say, hey, I'm going to look and take what I can get from this management consultant. Where is he good at? He's good or she's good at pattern recognition. They can tell me, hey, this is what the next round of investors are looking at. And now I want to digest whether that makes sense for my business or not. Do I want to switch on these levers right now or not? Right? And I think it's a function of, how strong you are as a founder and understanding, right? I mean, a lot of founders are just really trying and, there's a problem. The reason of failure is the business by itself is designed for failure. Like you said, such a high failure rate, right? It's easy to blame someone, right? But ultimately, choosing what advice, it's like being in my personal life, right? I have 20 people giving me advice. What kind of advice I take from whom is extremely important. But I agree that do not fit the models that work for a public company into an early stage company, right? And I think the last part, on this, I would say use the strength of the investor, right? And bring it into your business in the way that suits you best. And it's not like the investors are not aware of this. That's why if you see any good investor, now they've started having two teams. There's the investment team and there's the platform team. And that shows that the industry is listening, right? And generally you'll see platform team filled with ex-operators who help you with marketing, with your fundraising, with your talent acquisition. So I think the market is evolving. You have to again understand India as a venture market is a very, very young market. We've probably gone through the first cycle, first few IPOs, if I will, right? Which is where the culmination of the venture cycle really ends. So yes, there are challenges, right? And I think smart founders are able to sniff that out.
So what would be the main checklist, Saras?
So see, I think I think both of them made a good point, and to be honest on that point, I honestly don't know on what context Mr. Khosla made that comment. See, the checklist, of course, it's like a marriage, right? If founder and investors coming together is like a marriage. Uh, if you have choices, if you are the startup of town that everybody is eyeing to put money into, then maybe you have choices and you have 3-4 term sheets. Maybe that was the case 6 months back, a year back. And I know personally a lot of founders, my portfolio companies, where the decisions were made basis which investor I would want to go to. And particularly at the same point that Sanjay mentioned, that I am getting, somebody senior on board. I don't have to deal with, let's say, an analyst on my board. So it's a big name fund, but they are putting in a junior person. I would want somebody senior to be on my board because I feel X person could add a lot of value to my business.
Right.
While the valuation might be 20%, 25% less, I don't care in the long run, but that's a value I feel I can derive from that individual coming in onto my board, right? So if you have those choices, choose that. But as Jiten mentioned, life is not easy on any side. What you'll have to do eventually then is stitch together the round. Take best of what you can get, because if you are looking to raise $5 million, the guy who's coming in whom you want on board, they are coming in with $1 million, but somebody whom you feel is not going to add much value, but it gives you more of a bragging right, and they are coming with 4 million. I mean, you choose. I mean, that's the evil you will have to take. And how you manage is also part of the founder's role, to be honest, right?
Right.
In terms of, see, life is, everything comes with a package. There, in life is what I believe. You keep good things to yourself. Whatever doesn't work, just leave it aside. You can't be sort of, thinking that everything would fall in place like I would have imagined. So as a founder also, you will have to make those choices and choose what's best for your business in the long run. Money is also important consideration at that point of time. The color of the money is also important consideration at that point of time, and the value add that somebody would bring in is also sort of very important at that point of time. So you'll have to apply your sort of brain as a founder and see what's in the best interest for the company in the long run.
So tell me, in early stage, when founder, as Jitendra also said, that you don't have many options, right? Choose the ones you are getting. But in that way, doesn't it impact a founder business? How does a founder, even in the starting stage, where you're saying you don't have much options, select whoever you feel is going to invest? But that can also impact a person business in long run, right?
It's a question, right? Again, starts off what are the options you have and what do you balance, right? I mean, if some no-name fund came to Sanjay and said, okay, take my money and you run the business the way I want to, he's going to say, go take a hike. But maybe someone who's really struggling, right, has like 2 months of salaries unpaid, really wants to make this business. And maybe she or him might decide to dance with the devil and swallow the bitter pill, right? It's very, very, I would say, situational, right? And there is no straightforward answer that one can give you saying, hey, you should do this or you should not do this. Like going back to what Sanjay said, you're not walking in my shoes, right? I mean, how can you decide that? It's very easy. Like we'd all love to have, okay, X, Y, Z angels on their cap table, right? Today, as my cohort is graduating, right? We are trying our very best, right? To make sure that we craft the cap table, right? But I think what's interesting is you can sort of choose, right? You want some cheerleaders on the cap table. You want some strategics on the cap table. You want some only money guys on the cap table. You want some solid partner. Like, and there's a saying in venture, you don't choose the fund, you choose the partner you work with, right? Now, again, this comes as a luxury. Going back to what Jiten said, if you can create that FOMO, right, where people are dying to get into your round. I mean, YC demo days used to be like that, right? I mean, you didn't have to probably make a deck and there'll be like checks being thrown under your door, right? So it's like not exactly, but you get my point, right? So, it completely depends the dynamics, right?
No, it's very situational. Take example of PTM itself, Vijay Shekhar Sharma's journey, right? I mean, eventually there was a situation where he had to do a round with few angels. He had to sell, major portion of his company. So it's not like a perfect picture that we draw that, I have X thing in mind and, when all check boxes would be ticked, is when, I'm going to accept money. It's the, optimization that you do at that point of time, because you have to pay bills. There is a team that you are answerable to. You have brought a company to a certain stage. You don't want it to go downhill from here, right? So that's one piece. The second piece, I think, where most of the problem comes in, and to be honest, I think I see the meeting of minds from investor perspective is also, he said, like, both of them as a founder touched upon an important point. I'm building this for long run. I'm not building this for 10 years. And there is what Keshav said, the product being sold in the VC world to LPs, we sell 10-year window. Unfortunately, SEBI doesn't allow us to make a fund which is evergreen, right? There are problems there on the regulatory side. But see, if you have that view, and if you believe that, I'm not somebody who will be able to build this for 10 years, you will have to accordingly choose those kind of partners. Maybe you will be better off going to, folks which are sovereigns, for that matter, who doesn't have this fixed fund life. You are better off going to, family offices. We do not have this problem of, finding an exit in 6 years or 8 years. I think that's choices you can make. And again, I mean, that would all depend on what convincing power you have to get people excited and come and join you in that journey. So, right, I think those choices, of course, are available to you.
Actually, one of the easy thumb rule that we practice is like talking to the portfolio companies, which are already, so between VC1 versus VC2, if you get you talk to the portfolio company founders, you get fairly idea. Like typically talk to the ones who have actually failed. You'll get a good idea from them, and you will get also good idea from the successful ones. Like if you look at the history, there are a lot of, in India, there are a lot of very, very successful companies actually had problems with the initial set of investors because of rights, liquidation rights and all that. And we have seen them not doing that well. So now if you talk to the founder of that company, portfolio company, we'll get a very good feedback, and you can decide between VC1 and VC2. So that is a good practice I refer to.
So tell me, coming to that point, in Proptech ecosystem, we are noticing VCs are doing safe bet on B2B market. They are doing safe bet when it comes to companies like No Broker and all, because the model is understandable. Plus is B2C. So you know the returns, how it would be. But when it comes to companies which are like channel partners, B Square Yards or for example, the recent one, Property Pistol, we are seeing they are able to raise funds only from banks, but not from VCs. So, for example, Ashish, the founder of Property Pistol, said clearly that when they went to VCs to make them understand about their model, which is a channel partner model of theirs, they were not ready to bet in money because they are very skeptical when it comes to real estate market. But when they go to a bank, they are ready because they can vision the complete how the bigger picture will be when it comes to channel brokers and how the real estate market is evolving. So do you feel when it comes to Indian VCs, they are still doing safe bets when it comes to Indian PropTech ecosystem? I'll start with Jitendra.
I think it is not about safe betting. It is much more about how VC works and how banks work.
Yeah.
Right. So VCs will really work on a multi-X exit.
Right.
Okay. So they look for a story which has a huge market. And typically, if you're talking about the B2B channels market like for selling primary sales, majorly are in the primary sales.
Yeah.
It's fairly restricted to in a year, we sell around 300,000 houses in India. So 300,000 houses, and typically the average sale price is 60 lakhs. Okay. Out of that, every of all this B2B guys will maximum have a capacity of 2% of it. So that's is a market potential which is 4,000 crores. Right. So 4,000 crores is not exciting for most of the VCs, big VCs, right? But if you look at a bank, they're looking at the cash flows.
Yeah.
So all of these guys are having good cash flows, right? Which is commendable. And this business has potential to, build to a fairly large 4,000, 3,000 crores company in the long run and in terms of revenue. So that way for a bank to invest, it is easier because they see the cash flow, they see that I'm investing and getting a return.
Yeah.
Whereas for any particular VC, that multi-X exit, they don't foresee that. So that's the reason much of the VCs have not touched that part.
That's a good problem to have in my view, because you don't have to dilute if bank is willing to put in the money. Right?
Yeah.
And to be honest, unfortunately, any founder I'm sure would agree with me here that they would want to accept money from bank than VCs because it helps them, save dilution in the company and build larger value in the business. So from that perspective, honestly, I feel it's a good problem to have. I would love the banks to write checks, fund the founders. I think the VC comes into play because banks are not willing to take that risk, right?
Yeah.
And they are basically balance sheet based investors. They look at cash flow and then eventually if they get comfort, they will, sort of come in. VCs exist because they have to take that risk. I mean, that banks are not willing to take in early stage. And I think that's a good problem to have in my view. Regarding, whether VCs are taking risk or not, I think, honestly, while I think this asset class does exist to take risk, the biggest challenge for this, ecosystem had been finding quality exits in a market like India. And I do agree, unlike maybe a lot of time we end up comparing, hey, in US X happened, Y happened, people, early stage bets. Where I think the challenge is, I think that the depth of market is very different in terms of the market size and, in terms of the availability of capital and everything. And that's what I would agree that we are not as sort of, risk taking society. I mean, that's true with everything that we do, right? I mean, our risk appetite is much different from, let's say, a developed market because the way they are brought up, that has been different. The depth of the market is different. The capital which is available, in terms of risk taking ability is different. So that's the fundamental difference. Hopefully, I mean, we have, quality founders like Jitendra and Sanjay. They will grow these big companies. A lot of, the folks who are eventually getting exit, they are coming back into the VC business, setting up their own shop. And I think that is going to change the risk profile, right? In terms of what kind of startups you back, and their risk appetite would be very different from, let's say, traditional LP.
True. So Keshav, you must have seen all the accelerator programs under Brigade REAP. Recent bet is on clean tech, smart tech. It's giving you that kind of returns. That kind of, I would say the trend is happening, sustainability, and everyone is talking about it, and even investing. Of course, it's important and it's a way to go ahead. But you would be also seeing few startups in your accelerator program which are not maybe replica of global players, but are also facing challenge to raise money because there is, for example, more on the front of a channel broker or even in the work towards the developer front to create that kind of tech, not for the customer. So how you go about it? Like, how do you make sure that founders understand that there are still a risk taken by a few VCs, they have that appetite, and how do you make sure their motivation is there?
So I think it sort of ties into the earlier question, and I'll sort of explain that why, right? The kind of capital that is available determines a lot of sector when it starts getting hot or not hot, right? VC as first check becomes a shorthand, right, for anyone who's trying to raise funds. I have to understand, I think going back to what Jiten said, right? The risk profile for a VC, the kind of, you have to understand the product, right? I mean, if you understand the product, it's very easy to understand. When I go to a bank, why a bank gives me a 9% loan against a home loan? I simply think of it like this, right? Why is a home loan running at 8.4% versus a personal loan at 12%? Or if you go, I will not name another fintech, right, will give you 24% personal loans instant. Because the risk profile, the appetite, where you get clubbed in is very different. Same way, when you come to venture, right? There are a lot of founders who walk in and say, listen, I've got a sustainable business. I've got 2 crores of revenue. And you're willing to, all the VCs say this is not good enough, right? Because maybe for some people, like I said, 4,000 crores itself is not exciting market. So they then say, but you'll go and fund like a person who's, the repeat founder and he's going to burn the business down. Because ultimately, right, I mean, there's a certain outcome that a venture capital desires. So it's very important to understand what kind of output is required and do you fit that profile, right? The extra 100x return, especially at the early stage. Because if 80% of the companies are going to die, 20% have to be extreme outliers. And that's a far number, and not even getting into the fact of will they actually get an exit with the depth of the market. Right now, coming to the second part in terms of availability of capital for alternative companies, right, or ESG companies, right? I look at, we've all discussed that the ecosystem is young, right? We've had a few IPOs, so I look at the venture journey in India in 3 parts, right? What happens on the screen, which is a lot of consumer, skeuomorphic era, right? Things going from offline to online. Then what happened behind the screen? This is the API and infra layer that really came out with the SaaS businesses, and so that was the second part. Now the third layer, which we are finally in, is what's happening outside the screen. And now these are difficult businesses. Let's not kid ourselves, right? When you're working with the built environment, these are not easy businesses to build. So finally, when we have founders who are more confident, right, who've been through a journey once, twice, right, and are ready to dedicate that time and energy, that is when the ecosystem moves forward. Now, secondly, it comes to the color of capital, because a lot of funds have been raised with a very ESG focused mandate to their LPs, right? So when the capital goes, now what you have to balance is the capital and the talent and the number of companies that are being formed. Is there an equilibrium? Otherwise, again, there will be a bubble and then the ecosystem goes back by a few years, right? Having said that, we are at least at REAP, right? I mean, in this cohort itself, I think we have 2 companies that are working, right? Team of great scientists, do not come from Bangalore, come from the east of India, right? Trying advanced nanomaterials to reduce clinker. We have a company, the founders are here who are actually using up to 80% of plastic in building paper blocks, right? Which is not very typical that you hear coming out of, our ecosystem. And these are difficult bets and they've been at it for years. And now we are finally seeing an appetite when we are taking them out and meeting investors, right? But they're willing to bet small, but they're finally betting, right? Earlier, even if you go to a developer or any consumer, right, of real businesses, our metric was very simple. We used to say, show them either how can you help them reduce cost or make more money. Now, finally, the third element is coming into picture, which is the sustainability. And why, right? A lot of it you'll see is in the commercial space, because now you have Amazons and, the Walmarts of the world, the global players are coming to India. They've made net zero targets, right? That they've taken certain targets. Now, you can't take it in isolation, right? You can't say, okay, I'm going to do only net zero in the US and Europe, and all my other presence can be like, I'll just buy carbon credits, right? I think companies are going to see a downstream effect. So if you have a large occupier, global occupier who has net zero targets, automatically there's a huge change in terms of, what the builders are building for, right? And ultimately those builders have to be supplied by new age companies. So it's a trickle down effect. But finally, we are very happy to see that the third consideration for startups, apart from cost, reduce cost or make more money, the third part, help me become more green. Like literally we've had developers coming and, speaking, what are the portfolio companies can help us become more green? And now then we sort of work with them to say, hey, just becoming green is a very big, problem statement. Can we break it down? But yeah, that's what I'd leave it at.
Sanjay, you want to add to this risk appetite of investors in the Indian market?
I think SAFE and VC don't go in the same sentence together. I think it's paradoxical in nature, so it doesn't make sense. In terms of why banks invested in certain companies, if you look at the type of companies that they've invested in, I don't think fast-growing founders have the time for a bank in India to make a decision. True. Right? The people with options, the best investors, they don't have time for any of the ICICI SBIs to wait 3-4 months. I got to run a goddamn business, right? I can't wait for a decision. And so if YC, who is probably one of the best early stage investors, we went through YC, if they can make a decision fairly quickly, then, you probably have something to learn. And they've done pretty well. Their return on investment is far greater than any bank in India. And if you look at the type of founders they're invested in, they're investing in a lot of, I would say, seasoned, more executive style founders, which probably fits with the management of the bank itself. The bank management probably is a reflection of the founders they're selecting. So the way banks work is probably risk-weighted returns. The way founders go for is growth orientation.
Yeah.
Growth optimization. These are very two different ways of looking at things. And so banks can possibly invest in these startups and say, look, they could be part of my workflows. And if you also look at the valuations that these banks are investing in some of these companies, they're not great valuations, right? And even if you look at the banks in India, and they're very different than how Western banks are run. Broadly, you can break down business in India into who you know type of business or what you know business. Founders tend to operate in what you know business. Banks and bank executives tend to operate in more style of who you know business. If you look at loan portfolio concentrations, they'll go to certain corporates. It's a very relationship-based business with banks. So you probably need to build that relationship. You probably need to go through those timelines, but I can guarantee you, Swiggy or Zomato or none of the good founders are waiting around for banks to make decisions. And they have to deal with regulators. They have to deal with these boards, and the speed of decision making is just abysmal. And it must be nice to run one of these public sector banks, knowing that you can wake up in the morning and be protected by the government on the downside, and the upside gets attributed to you, and you can always exit and become an advisor at other companies and corporates, right? I would love to be the chairman of SBI. I don't know what risks I would have in running my business, what threats I have, because the government ultimately gives out a license, and the government is also my shareholder in my business. What a fantastic moat. Startup founders would die for that. But for people in that position, I would not say that skin in the game, again, is truly reflected in the character of that organization, or they would know how to see it in others. Rarely do you see young founders getting funded by banks in India. Why is that? And I'm talking about lower than 50s or 40s. So I'm not saying all the founders they invested in are old. That's not the point. I think I'm in my early 30s, and I think I'm old by startup standards. But banks operate in who you know business, not what you know business. And it must be nice to be the chairman of SBI. That's all I can say.
Great. So on that note, lastly, I want to ask from each one of you, the upcoming emerging trends, one or two, which you think is currently small but will have a substantial growth in the future. Starting with you, Saras.
See, to be honest, I would want the founders to tell me, what they're thinking about and what they believe is going to be next thing. But see, broadly, I think Jiten and I were having this conversation, and some of the ideas we were discussing about, this fractional ownership is still very small. We would see many changes, around fractional ownership. It would be culmination of different things, right from blockchain, in terms of providing that safety net, around, the safety of those investments and your ability to sort of prove that these are essentially the transactions that you own. Your ability to leverage that in terms of maybe making small check investments, maybe $1 lakh or so. We were just discussing about, let's say this bar, you want to own, few percentage of that.
Yeah.
A lot of AIFs could get created.
Yeah.
So of course, that's one piece, definitely we feel is going to be, it will come. The second piece, of course, that we are seeing still very early days. I think there are going to be a lot of plays around sustainability. But to be honest, sustainability in India is going to take a very different shape and form than the Western world. I don't think, we will pay for sustainability because, honestly, people have certainly woken up and said, hey, I'm caring for environment and therefore I'll make sustainable choices. I think a lot of that would also be driven by cost consideration. So around energy, around water conservation, I think those are the spaces where we would see a lot more actions in the coming days, if I see the broader Proptech space in general.
So I think it's always about the founder, right? Unless you're talking about a generational shift in the platform on what things are being built, right?
So emerging trend in Proptech ecosystem right now.
I think more and more, focus on, those who are focusing on distribution. And I'm not talking about distribution of products, right? I think distribution to the customer, right? Be it a SaaS founder, right? How are you increasing adoption, right? Those who are, like I said, we are so early stage in our journey in PropTech. And not India. There's a dated McKinsey study that says we are the second lowest in terms of adoption, right? Only after agriculture and hunting. And that's a fairly low bar to beat, but so I'm happy that we beat that, right? But less than 1%, right? And a simple number. And that's why I don't want to, not that any founder is going to start building in a section, and you should not just because some investors are saying it's a hot area. But he mentioned, right, we sell about 300,000 homes a year, right? We are the same population as China. 2022, China made 6.2 million homes. We made 0.3 million homes, right? So that is the gap that we have to catch up, right? So I think I'm extremely excited about affordability, right? If you can do it sustainability, more power to you. Like we are there with checkbook. I think anything that becomes affordable, right? That to us is extremely exciting. right? We are seeing dedicated effort, and we have some folks in the crowd, right? Because now there's a lot of capital. There's a little bit more room for the founders to play in the ESG space. So I think sustainability, but don't just look at the green line, but also look at the black line, because that sort of sells the combination of having a dual impact, if you will. I think those are the two sectors on a very broad level. I'll leave it at that, right? I mean, we could always talk about impact of Gen AI and blockchain, so all that stuff. But for us, it's about the founders, right? I think what founders are excited about building, and if we can find some merit in backing that.
True. Sanjay, according to you, where do you think what is currently the small, still emerging, but has a great substantial growth in future?
Yeah, I think like you were saying, sustainability is for India overrated, and it's not appropriate for us at this point of scale and development. I understand it's important for Brigade, Sattva, because I'm sure majority of your best paying customers are Western corporations setting up ops in India, right? But if you actually kind of look, we have a much larger fish to pride, and that comes from both civic innovation, meaning the states need to decentralize and give cities power and municipalities much more power to make decisions instead of using the large cities in the state to subsidize the rest of the state. Every election, I'm talking about Bangalore, I'm talking about Mumbai, I'm talking about a lot of these cities, right? These municipalities have budgets greater than some of the major states in India, yet they don't have a strict dedicated person doing that. And an offshoot of that is cities need much better urban planning. I think that's the biggest problem that India has right now. The zoning, the infrastructure lines that need to be laid, the public utilities, all of these things essentially are gainful investments for a country. So whenever you invest in infrastructure, you want the rate of return for that infra to be greater than the cost of capital over the long run. And you don't really do that with the ESG in India. And also there's a huge differential in terms of rental prices, right? You did mention, for instance, Amazon cannot have buildings in Seattle that are ESG and then have in India that are not. Well, they're certainly paying those employees much more differently in Seattle than they are in India, right? However, they care about that because that's what their home market dictates. That's what their shareholders are dictated. But in India, I'm not sure sustainability is a thing. I think government innovation in terms of municipalities, zoning needs to be improved. One of those things, I can tell you, for instance, we did demonetization. Now, the idea was to cut down on, let's say, black money. If you really want to cut down on black money, all you have to do is close the gap between guideline values and true market values. Majority of the black money in India gets circulated because of the differential between market value and circle rates or guideline value. So you have to go down to the actual cause. I mean, there's political reasons for it, but that doesn't mean we should deny that it doesn't exist. I understand. I operate in this environment. It's okay. We're a growing country. We'll get there when we get there. But I think public utilities, zoning, infrastructure, these need to be changed first before we even consider talking about ESG as the catalyst for growth in Indian cities.
True. Jitendra?
I think as India is growing well, like a 5 trillion economy by 2030, typically many of the reports typically suggest that real estate will be like 1 trillion. Okay, so 1 trillion in terms of size. So it's obviously we can't beat China, but we'll be like almost instead of like 5% of China, we'll be like 25-30% of China in size. So what will happen is one interesting figure is like how much is Proptech portion of the real estate, right? Suppose the real estate becomes 1 trillion, how much will be the Proptech size? Okay, so there are a lot of reports, like I have also spent a lot of time to understand, but the rough estimates is 100 billion. Okay, so almost 100 billion is what we can actually see in Proptech. So today it is less than a billion, right? So it has to grow 100 times, right? So 100 times it has go, like the channels that are available today to grow are like not working. So what we have seen, like early stage startups, late stage startups are all struggling with ideas which are not scaling. Why it is not scaling? Perhaps what we have anticipated, the rate of growth of the middle class families will happen to India, to the upper class, it's not happening. Okay. So what will happen is what is happening in India, if you see apart from PropTech, is retail investors are increasing.
Yeah.
Right. So like if you look at the normal retail investors for or vision for this normal share market, it has almost become 4x the last 30 years. So that number is increased. So what is, as a trade, what is in C is people who want to invest in the alternatives, that is increasing drastically. So what it means is people don't want to invest set at 7% fixed deposit.
Yeah.
People are not buying homes that often because they're telling that I want to keep I don't have enough money to buy home. Down payment is like, I have to take a personal loan to pay the down payment. So that is happening. So what will happen, what I think is, the democratization of real estate will happen to a large extent. So typically, huge tech parks will not be only owned by few developers and few family offices, right? So people would love to invest there. And that as an option will start happening much more frequently. So you have AIFs which will happen, you have action ownership that will happen, and people will be like, can I invest like 10,000 rupees in a tech park here and be a shareholder there? So REITs will happen much more, right? So, and these are the plays which will happen at a very high level. And it will be largely, again, few business families, few tech park owners will start this, and eventually a lot of alternate funds will get created. Now, like, there are, and the limit of entries are very high. Like AIF, we are talking about like 1 crore is minimum, right? So now, how will the normal investors will come? How will retail investors? That is where a lot of startups will come now, which will create platforms where retail investors can come in at as low as 5,000 rupees, right? So that is something, and where like blockchain technology will be fairly used to create these avenues. There also I see a lot of Proptech investment will happen to create these avenues where retail investors can participate in the larger picture. So that is going to mostly be the future for Proptech in India.
So thank you so much, guys, for joining us today. And it was wonderful to gain some insights and drill some VC questions, I'm sure, which have helped even the founders present here to understand about the pitch deck, to understand the risk appetite of VC and much more. Thank you so much.